Hello, everybody. Rachel Smith, Remax Realtor. You know we like to get real with Rachel. So today I'm switching up a little bit and coming to you from NFM Studios with none other than Jeremy Poling from NFM Lending.
How are you today?
I'm good. Usually I'm saying thank you for coming on, but I mean, we're kind of
shifting roles today, right?
Shifting a little bit of shiftage here. But yes, I do have some things that I want to ask you. Right. So let's get into it. Starting with a comparison of 2020, 2021, 2022 markets. If we were to look back on how those markets were with how crazy everything was, and then compare it, let's jump into right now. We are fall 2024,
right?
Nearing the end of 2024, finishing it up. What are you thinking? What do you see when it comes to a comparison of how crazy and wild that market was and what the market looks like now? And I know you like to do a little bit of hunting.
Yes, I do. Yeah.
So maybe we could use a comparison from hunting. So what are we hunting? Back in 2020, let's say you were hunting something crazy. Bird hunting is what we talked about previously.
Yep.
So ducks, that's high speed.
Okay.
Right? So would that be our 2020?
Coming as
and
fast
then
as,
now what would the market look like in 2024? Are we just chilling out, sitting down? What are we doing?
Well, I mean, that's a pretty loaded question, right? No pun intended. But, you're right? So duck hunting, right? Birds come in fast and furious, right? Turkey hunting, you're kind of sitting in a blind or sitting up against a tree. And
so we're comparing
slowing down a little
ducks
bit.
and turkeys, right?
Right?
So
Bird
we would
hunting.
say that everybody was kind of in that whole duck shooting phase back in those markets of the 2020, 2021.
Everybody was in a hurry. Everybody
ready to go, rapid fire. Whereas now it's a little bit more sedated. So, dude, take your time.
So,
creatures are slower. Does that mean the market's slower?
Fall of 2024. I mean, we've seen some pretty significant market movers recently, right? I mean, not to necessarily dive too far into the political side of it, but we're in political season, right? We're in election time.
That's true.
Jobs seem to be coming back. ADP job numbers, are strong 2 months in a row now. You have growth across the nation that quite didn't hit the mark, but the bigger number is in our industry, right? September of 2024, home settlements, home sales, increased by 7.4%. So it's not that it's completely dead out there, right? It's just changing from maybe a seller's market to a buyer's market.
Yeah.
Right?
Yeah. I think in pockets, obviously, always, and then where our territory is, it's always, we're seeing still bidding wars on some properties, I think, that are really marketed well and priced appropriately. And then we're also seeing the whole price modification, price improvement, price enhancement. Those keywords.
You bring up a really good point, right? I mean, geographically.
And some others, but we're seeing it, and I'm getting those emails more and more where the subject line is price improvement, price modification, price refinement. So it's very interesting to see because that's going to lead us into what plays into those markets. Obviously, the mortgage rates on the buy side. And the last time that we chit-chatted, it was right before Jerome Powell got up on the podium and talked about what rates we're going to be doing and what the final verdict was going to be as we were anticipating a drop. However, I think we had kind of thought that it was going to be a quarter, and it ended up being a half. Now, that's the Federal Reserve rates, obviously, that interplays with mortgage rates. So tell me what your reaction was when it went from a quarter to a half. Are you like, whoa, blindsided? And how did the mortgage rates react?
Now, I was not blindsided. The markets were, right? They felt it was too aggressive because on that previous rate drop.
Scary. Like, why?
Rates actually went up, right? We're staring down the barrel, in the month of November 2024. All of the economists are saying we're going to be at another 0.25% drop. However, if we back up to September of 2024, when they came out with that aggressive 0.5%, oddly enough, the bond inverted and actually went higher than it previously was. So they dropped rates, but rates actually went up. The overnight rate went down. Mortgage markets and mortgage.
It was almost like a tease. It was almost like they were saying, "Okay, here we go," but all in all, really nothing came of it. It almost had an adverse reaction.
Right.
So our next meeting, I guess we'll see what happens. How many are left?
November, you have a rate decision, right? The beginning of November.
So we'll see what happens there. Exactly. That's coming up.
The most important thing to come from that is going to be the verbiage that they talk about going forward, as you will have gone through an election and you will be preparing to finish out Q4 of
2024, and then what we can expect into 2025.
Right.
How violent that could be, or is it going to be more of a monotone?
Tuned.
Yeah.
Stay tuned.
I think there's some violence coming.
Yeah.
I just don't know when.
Yeah. There's definitely volatility within the market that we're seeing now.
Yeah, there is. And I think everybody's kind of poking their heads around like, okay, now what's happening? We've seen these rates that have been high since, gosh, was it fall of 2022, essentially?
Yes.
That we had that sucker punch. Yeah. And they've creeped up. We've had that teaser, just like we talked about. But I think a lot of people are holding their breath, buyers in general, thinking that we're going to have some type of drastic drop back into the twos or the threes, high twos or the threes. But realistically,
something bad will have to happen.
I was going to say, if that were to occur, I think there's bigger things on the horizon to worry about than just what the silly mortgage rates are doing, more like what the world would be doing, because our economies are crashing. Yeah. But with that said, 2025, we're hoping will at least stay consistent with what we're seeing and come down. Do you have any predictions for 2025 mortgage rates?
So follow the money, right? Just talked about September's numbers, spiking 7.4%. Home sales, that's pretty significant, right? And that was just from a 2 to 3 day window when the bond market and the mortgage-backed securities actually, in fact, did, ahead of the Fed meeting, lower interest rates across the board, right?
That's kind of like
so follow the money, right? Look at the jobs numbers. Look at payroll numbers, right? Look at household income averages, right? If you start to see that there's going to be a negative press conference or any negative verbiage coming out of the Fed based upon those figures, you can probably expect some volatility in the next 7 to 10 days after that meeting.
That's so interesting.
Yeah, follow the money, right? So 2025, most folks are saying that the, easement that we're looking at now, should give us, slightly 0.25%, 0.5% advantage to today's rates. We'll see. All right.
We'll see. People got to have houses, right? People got to buy them. And I still will be a strong, firm believer in that it's better and essentially cheaper to buy, a better investment to buy versus renting. But you got to do what you got to do. However, everybody's goals are different. With that said, speaking of investments, I wanted to pick your brain because not only do you see the purchase side of things, but you also see the refi side of things, cash out refis and things of that caliber. With these higher home transfers, record selling, you're seeing more equity that's available.
Of course.
So are you seeing more of these cash out refis now that people are still kind of riding off of the highs of the market? That's something that when people are asking me, Rach, do I sell? Do I refi? Well, think about it. If you have substantial equity left in your property, it may behoove you and be wiser to take out and still have some equity, because usually it's like an 80% LTV, right? To do whatever repairs you might want and then keep improving on your investment, because I'm a big believer in the construction and the remodeling. But are you seeing an influx on the cash out refis or even refinances in general?
So I wouldn't necessarily say there's an influx, right? Higher rates always will, have a downturn on that side of the business. However, I will tell you, going back, follow the money, right? We're at record household debt levels right now. So interest rates go up on the mortgage side. Guess what else they're going up on? They're going up on your short-term interest rates. So your credit cards, personal loans, car loans. So imagine if a consumer is holding, say, $100,000 in consumer debt at an average of 20 to 29% APR, right? That attractive 7% on the mortgage side seems pretty fair. Right? So follow the money, right? The families that are caught up in the debt race right now and, some of the situations that are out there and they're unfortunate, they are tapping into that equity. Are still riding from the highs of 2020 and 2021 that are at a 2% interest rate. Normally, we don't see as much as a cash out refinance. I mean, those folks have started to use some other home equity conversion models, right? Home equity lines of credit, personal loans, equity loans. But yeah, I mean, we see it now with the debt increasing.
So interesting. Yeah, because again, having all of those sales closed, again, when an appraisal is coming back, it's like, okay, when it's comparison on the purchase side, it's also interesting to see what's happening on the refi side and leveraging that equity that's been built. How is it? Is it by selling and using that to, put down and buy new, or is it to stay in place and using that equity just to make your house more fabulous?
You bring up a good point. I mean, financial planners right now.
I'm always curious as to
financial
ride it, right? Ride the highs that the house is worth $1 million over the last 2 years. I mean, if the market keeps dropping, that's less that you can tap into from a investment standpoint.
Financial planners right now are really looking at the market, right? I mean, obviously you have Dow Jones breaking a few records, over the last few months. So in those investments, if you're making 20 to 35% on those investments, 7% also doesn't look that bad, pulling it out of that, right? You're just basically transferring power from a real estate investment vehicle into something that's a little bit more strategic through your investments.
But having more of an opportunity to do so with these higher prices. Key.
Dow Jones has broken record, I don't know, significantly for 3 months now.
Next question. Mm-hmm. Are we seeing investors tighten their qualifications on buying like mortgage-backed securities, buying the mortgage on the secondary market? Are they getting more scrupulous to buy the mortgages?
So 2 things here, right? So secondary marketing and how those are bundled and sold to Wall Street, that's a completely different animal than the risk and the programs and some of the guidelines changing, right? So there's an appetite out there right now, specifically with these higher rates, right? You have private money coming in. They're getting a little bit more creative.
We'll take the risk.
Yeah, they're getting a little bit more creative. I mean, I don't think we're at the level of 2005, 2006, but I do believe that there are some pretty cool programs out there that fit niche programs, and specifically in the investment side of it for developers, property flippers, individuals that are building their investment portfolio. There's some very aggressive programs that, are out there right now. Absolutely. Private money is definitely coming back to the market.
Keeps the industry going, right? Mm-hmm. We can't be stagnant. We have to keep seeing cycles and turnovers, and
in those
you're
areas,
going to need vehicles in order to do that. And if it's too scrupulous to qualify, but what I meant is, are you seeing investors that are buying the bundles of mortgages, are you seeing them back out? Are you seeing changes in that sector?
No, I believe that the GSEs, right, the government-sponsored entities that are out there, and some of the bigger names, Freddie and Fannie, right? I mean, they're on a buying spree right now. They're buying it up. I mean, think about it. I mean, interest rates are up, yields are up, right? So margins have to be up on that side.
Well, as always, just a plethora of information that we can always expect to receive from you. Thank you so much for coming on and sharing and joining me.
I love it.
And until next time, bye.